The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
This is Your Money, Your Call.
Hello, yes, your money, your call, but tonight we're calling it your mortgage, your call. I'm John Kerrison. Chris Gray and his team have taken a break just for this week. Now, if you have a question about picking a mortgage, managing your mortgage, refinancing, switching lenders, our phone lines are open, 1300 30 3435. Or if you prefer, you can email us, property@skynews.com.au. Also tonight, an experiment of sorts. If you have access to Twitter, we'll be watching tweets with the hashtag YMYC. Try sending your questions via social media. Joining me in the studio today is John Manciamelli, a broker with Mortgage Choice, Greg Cook from Eureka Financial Planning and Damien Smith from Rate City. Gentlemen, thank you so much for joining us in the studio today. Greg Cook from Eureka Financial Group. As a financial planner, it's not just mortgages, is it? It's then people deciding, I have to manage my money here to have a mortgage as a part of my life finances.
Yeah, for most financial planning practices, the core of their clientele tends to be older people, the baby boomer generation, if you like, who have accumulated funds and need some advice on how to manage that and to save tax and superannuation strategies and so on. But yeah, for younger clients, Gen X clients, managing debt's an important issue. The sort of micro rate movements and things that have gone on in the last week or two don't give us a sort of flurry of inquiries like it would for John and for Damien. But yeah, I mean, my experience in the last little while is I see a lot of people with a little bit too much debt, and so yeah, managing that is an important part of a good holistic financial plan.
Great. Debt management, I'm sure we'll cover that in a number of times in a number of ways. Damien, I imagine there are some risks with redraw, particularly, Greg, managing money, having put extra onto your mortgage. There is some temptation, is there not, of taking that money back out? Yeah,
I mean, having reduced your principal, it gives you that flexibility when rates rise or your personal circumstances change. Also, for all of our clients, it's meant that when there's been tax savings opportunities with making additional salary sacrifice into superannuation, for example, clients have been able to dial up those contributions and lower their take-home pay, but subsidise their take-home pay with drawing back some of the extra principal payments they've made on their mortgage. So, I mean, if you're, I guess, to make a generalisation, if you're under age 40, that's probably not something you're necessarily going to look at.
Yes.
But certainly, as you get closer to preservation age and super age 55, it becomes quite a neat little strategy. Yeah.
Greg Cook from Eureka Financial Group. There are lots of mums and dads at home this evening looking at the kids, the car payments, and really worried about what we saw on that graphic.
Yeah, I guess financial planning 101 is to start with a budget. If expenses are getting a little bit out of control, income's not something that you can easily turn up the volume on, I guess. Yeah, so look, my quick tips on that, especially for Gen Y type people, for example, is to it's a little bit of a difficult exercise for a lot of people to do, but if you keep track over a month or two on where your spending's going, obviously some of your expenses are less frequent, but that gives you the building blocks to a budget and really make sure that you've got things under. Yeah, maybe. Yeah. One of the things, if I can just chime in, John, is that during the week, if memory serves me correctly, unemployment was up slightly, which actually is sort of built in. It's a little contrarian to what our caller's saying. So, yeah, I guess. One of the things for consumers to think about is fixing rates, and that's probably something for John to talk to more than me. I mean, my attitude with it is it's a bit like taking out an insurance policy. You're probably not going to work the market and necessarily make money from it, but if there's a lot of other variables going on in your life, or you've got a small business or whatever, it helps at least make something certain over a 3 or 4 or 5 year period.
Damien, if I can get your tips for someone who's about or worried they're going to hit the wall financially because of their mortgage?
Yeah, I guess in my experience, it's not just a 1% rate rise that pushes people over the edge to have to hand the keys in, as Greg put it. It's normally a coincidence or a combination of factors which occur. So statistically, if I can get it out, is also the loss of employment for the main breadwinner for maybe a period of months, and also it can be the loss of that income through sickness or injury. So one tip, for example, and it's a good opportunity when you're borrowing a significant amount of money, is to make sure that you've got your personal insurance in place, the main breadwinner's income protection in place, and you know, the life and TPD and trauma cover in place, so that you know, God forbid something happens, that the house hasn't got to be sold up in those circumstances as well.
You can do that through super, can't you?
Yeah, that's right. I mean, it's the most cost-effective way of doing it for most people. The premiums are on what's called a group rate, a cheaper rate, and the premiums are also paid on a pre-tax basis, which makes a difference. And it's not coming out of somebody's cash flow. It's effectively, for a lot of people, being paid by the 9% that their employer's paying in anyway.
Now, Damien, I'll come back to you shortly because we're going to talk about first home buyers and people getting a mortgage for the first time in just a moment. But from Eureka Financial, 7.8%, if you're sitting down and doing your sums and you don't have a mortgage, is really... you get some really worrying results if you're a first home buyer. There are schemes though to help first home buyers save money to get a mortgage. Tell me about them.
Yeah, that's right. The most commonly known one is the First Home Buyers Grant, which was higher than it is now, and the stamp duty relief and so on varies from state to state. In New South Wales, off the top of my head, I think stamp duty is waived for first home buyer purchases under 500,000, and then there's a slide down scale. But I guess one of the lesser known tips, financial planning tips for not just first home buyers, but often first home buyers' parents who are looking some way of helping their children save their deposit, is the First Home Buyers Savings Account.
Now this was a Kevin Rudd promise, wasn't it?
That's right. It came out in late 2008 from memory. So, look, you need to go online and have a look at it. It is a little complicated. You know, if you're a little bit green in these areas, you might need somebody to sort of hold your hand and get you through it. But basically, you can contribute $5,000 per annum to one of these accounts. The government makes a co-contribution, so this isn't the superannuation co-contribution. This is another type of government co-contribution of 17%, which is
quite generous, isn't it?
Yeah,
Although
it is generous.
Your money is locked in until you've actually ready to buy a home, I understand.
It was capped at 75,000. It's now capped at 80,000, so you can get some substantial funds in there. There are some sort of exit penalties, if you like, if you don't end up using the funds to buy your first home. For people who may be, for example, in their 40s and buying their first home, one of the ways of avoiding those exit penalties is actually to roll the accumulated funds over into superannuation, which can be a nice way, if you've changed your mind about buying the house, to still make good use of the funds.
Of that money.
That's right.
Now, I want to take Eureka.
Yeah, I guess my comment would be that when you look back over the last 20 or 30 years, rates aren't historically high. There's a lot of conversations going on about them at the moment, and rightly so. But when I bought my first home in 1989, interest rates are 17%. So I guess this sounds, it's got to pedal hard to make those interest repayments. So for a lot of people, there's an opportunity to pay down some principal and to build up a little bit of a buffer. It might sound a little bit old school, but it's probably a good opportunity to do that over the next couple of years.
And get some advice if you need it. Yep. You've been generous with your time. John Mantimelli from Mortgage Choice, Greg Cook from Eureka Financial, and Damien Smith from ratecity.com.au. It's been great to have our guests here on the panel. We are very grateful to have had them share their time, and to the viewers, callers, people who have sent emails and tweets. If you've missed something or you'd like to listen to the program again, go to the website skynewsbusiness.com.au and click on the podcasting link. Until next time, I'm John Kerrison. Thanks for watching.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.